In 1989, a couple in North York bought their first house for $285,000. They stretched to get in, both working. They thought they were building equity. By 1996, that house was worth $198,000. They lost $87,000 in 7 years without selling a single thing. They did not buy some risky investment. They bought a house in a normal neighborhood at what everyone said was a normal price. They spent the next 13 years waiting just to get back to zero. That was Toronto's last real crash. And right now, the numbers are starting to look familiar. Before the 1989 crash, Toronto had a 4-year run that felt unstoppable. Between 1986 and 1989, average home prices went up 150% in 4 years. A house that sold for $109,000 in 1985 was selling for $273,000 by 1989. People were lining up for open houses. Multiple offers were standard. Everyone said prices would never come back down, and Toronto was special. Demand was unlimited. Immigration was strong. Sounds familiar? Between 2019 and February 2022, Toronto did it again. The average GTA home went from $819,000 to a $1.3 million. That is a 63% increase in 3 years. Condos that sat at $500,000 were suddenly listed at $700,000. Semis in the Junction that were $900,000 were hitting $1.3 million. The exact percentages are different. The pattern is the same. A rapid run-up driven by low rates and fear of missing out, followed by a rate shock that pulled the floor out. Here's what actually happened. In 1989, 5-year fixed mortgage rates were about 12%. That's already high by today's standards. Then the Bank of Canada kept on raising. So by May of 1990, a 5-year fixed rate hit 14.21%. So people were stretched to buy that $273,000 house with a 12% mortgage were now renewing at 14%. So monthly payments jumped by hundreds of dollars overnight. So at the same time, Canada fell into a deep recession. Unemployment rose, household income stalled, and suddenly nobody could afford to buy. Demand collapsed, inventory piled up. The average Toronto home price peaked at $273,000 in 1989. By 1991, it already dropped to $230,000. By 1993, $206,000, and kept on falling. The trough hit in 1996 at $198,000. That's a 27% decline over 7 years. But here's the part nobody talks about. The decline wasn't a cliff. It was a slow bleed. Year after year, prices kept on drifting down just a little bit more. So people kept waiting for the recovery. It didn't come. So after prices, they bottomed out in 1996. They did not bounce back. They flatlined. So for the next 5 years, prices barely moved. Like the average home sat at about $200,000 to $220,000 from 1996 to 2001. I remember my mom talking about this. She was selling in the 90s, and I remember her complaining about how she didn't make any money on the house. And I was like, that's insane. How could that even be? Even though I was young at that time, because I was hearing them talk about housing and properties and people were talking about investing. When my mom sold her house, they sold for exactly what they purchased it for about a decade before. And she was pretty upset. I remember how upset she was. If you bought at the peak in 1989, you did not break even until 2002. That's 13 years to get back to zero. And you adjust for inflation, the real recovery didn't happen until 2011, 22 years. So think about that from someone that wants to move up homes. Say you bought a house in 1989, planning to build some equity, and you move up in 5 years. Instead, you spent 13 years underwater or barely breaking even. You could not sell without taking a loss. You could not access your equity for a bigger home. You were stuck. Now look at it today. When we're looking at the GTA housing market that peaked in February 2022, average was about 1.3 mil. As of early 2026, the average is down to about just $1 million. That's about a 25% decline in 4 years. When you look at the condo market, it's a little bit worse. Average condo prices have fallen from $800,000 to about $625,000. That's a 22% drop. And condo sales volume hit a 27-year low in 2024. And the trigger is about the same as 1989. Bank of Canada hiked rates aggressively from 0.25, which was like pretty much free money in 2022, to 5% by July 2023. Buyers got priced out, demand fell, and prices followed. If you're finding this useful, take a second to subscribe. I'll be very grateful. It helps me keep on making videos just like this. Let's get back to it. This is the nuance section. Not doom, not optimism, just facts. Both partners in the audience need this. The data-driven one wants a comparison. The other one wants to know what it means for their family. Before you assume 2026 is going to be a repeat of 1989, there are 3 differences that matter. Difference 1, interest rates are lower now. In 1989, people were renewing at 12 to 14%. Today, the 5-year fix is around 4 to 5%. That's still higher than the pandemic lows, but it's nowhere near what people were dealing with in 1990. Lower rates means lower monthly payments, which means fewer forced sellers. Fewer forced sellers means less downward pressure on prices. Difference 2, population growth is stronger. In the early 1990s, immigration to Canada was about 250,000 people per year. In recent years, it's been over 400,000 residents plus hundreds of thousands of temporary residents. Even with the recent policy changes, reducing those numbers, the demand baseline is higher than it was in 1989. More people need housing. That puts a floor under prices that did not exist in 1990. Difference 3, the decline is happening faster. In 1989, it took 7 years to hit that 27% trough. In this cycle, prices are already down 25% in 4 years. The correction is sharper. That could mean it also resolves faster, or it could mean we're not done yet. No one knows. And here's what most people miss about 1989. The people who got hurt the worst were not flippers. They were not speculators. They were regular families who bought a house at the top, planning to move up in 5 to 7 years. The exact situation a lot of you are in right now. They bought a house in 1989, expecting to build equity. Instead, the equity evaporated. When they tried to sell in 1993 or 1994, they owed more on the mortgage than the house was worth. They could not sell without writing a check to the bank at closing. So they stayed. They waited. Some of them waited until 2002 before they could finally make their move. That's not a market crash story. That's a life on hold story. Kids growing up in a house the family outgrew. Career moves delayed because you cannot relocate when you're underwater on your mortgage. Retirement planning pushed back by a decade. So what does this mean if you own a condo or condo townhouse in Toronto right now and you're thinking about moving up? It means timing matters more than most people realize. But you're not in the way you think. The people who got destroyed in 1989 were not the ones who made a bad purchase. They made a bad bet on timing. They assumed prices would keep climbing, so they stretched to buy at the peak. When prices fell, they had no cushion. The people who did well were the ones who bought after the correction with a clear understanding of their numbers. They bought in 1996, 1997, or 1998, where everyone else was still afraid. They got properties at 27 below the peak prices. And by 2010, those properties had tripled. So for condo or condo townhouse owners right now, the question is not whether the market will recover. It always has. The question is whether you can afford to wait, or whether waiting costs you more than acting. So if your condo has lost 20% of its value, your equity position is weaker than it was in 2022. Every month you wait, you pay your mortgage, your condo fees, your property taxes on a depreciating asset. If you're planning to sell in the next 2 to 3 years anyways, the longer you wait, the less equity you may have to work with. But if you move now, you're also buying in a market where house prices are down. The discount you take on the condo may get back on the house you buy. And that is the key insight from 1989. In a falling market, both sides of the move-up equation decline. The gap between what you sell and what you buy can actually narrow. The lesson from 1989 is not that markets crash and you should be scared. Markets crash, but they always recover. That is the cycle. The lesson is that waiting for the bottom is a strategy that sounds smart and almost never works. And people who waited for 1996 prices did not know they were at the bottom until years later. They only knew in hindsight. So the people who moved when their numbers worked, regardless of whether the market was at the top or bottom or somewhere in between, were the ones who ended up in the right house at the right time. If your equity covers a 20% down payment on the house you want and you can pass the stress test, the market cycle is less important than your readiness. The 1989 crash taught Toronto a lesson that most of the city has already forgotten. Do not bet on the direction of the market. Bet on the strength of your own numbers. Thanks again for watching. See you soon.